today. So hi guys. Yeah, I know a lot of you, but for those that don't know me, I'll just do a quick introduction of me and obviously what viSHEbility is. And then I'm just going to quickly pass you on to Andy, who's super keen to walk you guys through all of this stuff. So my name is Mary Mashakrai Adeyemi. I am the founder of viSHEbility, well, banker by day, social entrepreneur by every other hour when I'm not actually working on my day job. And viSHEbility is a social first organization that is working with Black women specifically, and our mission is to improve the outcomes for Black women in the marketplace through inspiration, coaching, community, and advocacy. We've been running since 2019, but kind of basically running in the middle of a bit of a down year, as well as through the pandemic and all of that. So a lot of re-engineering constantly going on, but the mission, how we do what we do always changes, but the mission is still the same, is to really empower Black women and give you guys the tools and everything that you need to just thrive, thrive in your work, thrive in the marketplace, thrive with your money, with your health, and so on and so forth. So lots of things to come. We haven't done actually one of these in some time. We used to do these like maybe every month at one point. So I haven't done it in some time, but I'm not a believer of doing things just for the sake of it. I think when we have good stuff, we'll make sure that we get the information to you. So thank you all for staying tuned, for staying on the mailing list, following on social media, and just being part of the journey, really, a really challenging journey, but the journey that has been viSHEbility so far. So with that, I am going to pass you on to Andy. Look, guys, you guys are in for a treat. So Andy's many things, but he's in his capacity as a founder of the Angel Investing School, where he is really, passionate, and his big vision is really to get more women and people of color into investing in startups in order to create economic prosperity and close this racial wealth gap. I'm sure we've all heard a lot about sort of the low levels of investing that's going into identify as Black or from minority groups. Andy is an investor himself and has invested in quite a few what he calls sort of gap closing companies, and he will tell us a little more about that and how you can also identify your own gap closing companies and get invested. Andy was voted top 10 BAME in tech in the FT and was recognized in 2021 with a Queen's Honor MBE medal. So we are in good company here today. And that honor was for to recognize his contribution to diversity and technology in the UK. So with that, thank you so much, Andy, for joining us. I'm going to hand over to you and disappear from
Thank you, Mary. Thank you. I miss doing events actually, and I miss doing this. So it's a real honor to be here today, and I come as an ally to the community as well. And I'm a big believer in empowering women and empowering people. I'm looking at myself on the screen, so I'm just going to change it to gallery view. Because I don't like looking at myself too much. Excellent. So thank you everyone for joining today. I'll give a quick introduction to myself, and then I'll run through the high level agenda of how this is going to work today. So I'm a father. I've got a 5-year-old downstairs. Should be bedtime soon, but I have a feeling she's going to wait for me to finish this before going to bed. As you know, 5-year-olds are quite creative, and she's with my wife downstairs at the moment. And I'm quite fortunate because in life I get to work with value-aligned people to do meaningful work for people who care, in a single sentence. The meaningful work that I've really dedicated the last 5 to 7 years of my life towards has been on how I can really help and support underrepresented founders and investors. And the backstory and the backdrop to why that matters so much to me is because actually, like in my childhood and growing up, I was very aware of the fact that my parents migrated from Ghana to the UK in the hope to give their children opportunity. And I think it's a story many people can relate to. And in doing that, I recognize that they sacrificed the life that they knew for an unknown life and for ambiguity in the hope that education will lead to opportunity. So I realized from a young age how privileged I was in just inheriting that privilege from being born here in London in the UK. While I had cousins back in Ghana and people that I visited in Soweto in South Africa and the favelas in Brazil who had high potential just like I did, but had very low access to opportunity. So that grew a curiosity in me as a young man to think, actually, what can I do as I rise in social status, as I rise in privilege to address the inequalities that I'm aware of? And the deeper I got into this passion, alongside this interest that I had in the technology sector, I quickly realized on a working trip to San Francisco in 2015 that none of the partners at these VC firms I was going to were Black. And it hit me directly, and it hit me hard, because these VC firms had accumulated such wealth from investing in what we call the internet today, from eBay to Amazon to YouTube to LinkedIn to Google to all of the phone companies that you literally have on your desktop on your phone, right? So for me, it felt like, why are we not being invited to the table, and why is our voices not being heard and acted on? And the reason this is important is because if they're investing in the very technologies that shape the very world that we live in, they should at least look and be representative to the very world that we live in, so that they're solving the problems that we actually care about. So I kind of dedicated my life from 2015 till today in doing work in mainly the US, UK, and Europe around actually solving this problem. So initially, it started in 2015 with me actually writing blogs and telling stories to people back home in Tottenham, some of my friends, some of the people that I grew up with, to say, hey, look at what I've come across, this world of technology and investing. How can I translate this into a language that's easy to understand? Because not many people realize, but actually investing is quite an opaque industry, and language is one of the barriers to entry, right? There's so many acronyms we use, from NDAs to SaaS, to all of these words that are actually really simple once you understand it, but are really difficult to decipher if you don't. And law actually works quite similar to that, as well as the medical industry, right? There's a lot of language that serves as a barrier. So I was writing blogs to people back home to inspire them and to democratize access to this education. From there, I started a newsletter, which I ran every month, to share inspirational stories of role models that were investors or were founders. And I'm a big believer that if sometimes you can't see it, you believe that you can't be it. And we've been in those situations, even in the workplace, where we look into leadership and we question whether there's spaces for us in leadership if we don't see people that we identify with up in leadership too.
Yeah, awesome.
So I think someone just answered the phone. Can you go on mute, please? Excellent. So I say this all in the backdrop to say why I'm here today and why I'm doing this work. And ultimately, the reason why I'm here and why I care so much is because I've discovered a lot of this knowledge, and I've been invited into a lot of these privileged circles. And I'm here to really democratize access so that I can spread more knowledge and more access to these networks that I have, so that people can recognize this opportunity as well. It's really important, before I share my screen and go into this whole presentation, this exercise today, to share that this is education that I'm sharing. This is not financial advice. I encourage you all to seek independent financial advice if that's what you're seeking. Today is not about financial advice. I'm not going to give you the top 10 stocks that I've picked. I'm not going to give you exactly the startups that I've invested in and you should be invested in too. Today's more about education, so you have that foundation of understanding, so that you can make an informed decision for yourself as to whether you're going to feed your curiosity and learn more about this, or actually decide that this isn't necessarily for you, but at least you can make an informed decision that's independent based on the knowledge that you hear today. Okay, usually at this point I ask for a thumbs up, but there's a lot of people off camera, so unless you know how to use the emojis, I'm gonna move on. Thank you. I see your thumbs up. Thank you. Thank you. I see it. And thank you. And I require that, because the energy helps me actually when I'm in these rooms. Thank you for all of the thumbs up. So I'm gonna go through this presentation, and then we're gonna get into more interactive conversational Q&A. Now, I want you to do two things. I want you to be really attentive and to enjoy what I'm going to go through. But I also want you to write your questions in the comments if you're like me and you're going to forget it when it gets to the portion where we're actually having a conversation at the end. Okay, so I'm that type that I'll just write my questions like blur as it comes to my head right into the chat, because I don't want to lose it and forget it. So you have full license to do that from now, right? So if there's questions that are even coming to your head now, feel free to write it down and get it into the chat. The last thing I'll say is I'd encourage you to take notes. Like, you know, I know sometimes we're just fully present and we're in the moment, we're soaking it in, but if you can, try and take some notes, because there's going to be some things that I'm going to be sharing today that are going to be new. And there are going to be some things that you might want to follow up with me or Mary on after this. So please do take notes, okay? So I'm going to share my screen and go to this digital whiteboard, which is going to serve as a part of our exercise today, okay? So investing in startups, and what we're going to explore today is a bit of a thought experiment around whether it's an art or a science. Is it something that you can control, or is it something that is totally outside of your control, okay? And there's a couple of kind of rules that I want to walk through first, all right? The first is, it's really important for everyone to just enjoy themselves. I want everyone to have fun today. I want to take you to church. I want you guys to enjoy being here and having this moment and sharing this evening together, all right? If you have any questions, feel free to unmute yourself or to put it into the chat. And at the end, we're going to have more conversation. And when I say at the end, I don't mean the last 10 minutes. No, I mean a big portion of today is conversation led so that I can answer the very questions that you care about. All right. If I'm laboring too long on a point, you have every right to unmute yourself and say Elmo. Elmo, I've been using it in workshops for years. All it means is enough. Let's move on. Yeah, it's real polite. I won't get offended. I promise you have permission today. Okay. And then finally, feel free if you want to screenshot, write down quotes, tweet, share it on your IG stories, do whatever you feel to express yourself and enjoy this moment that we're having today. Okay. So that's the exam question we're going to answer. Is investing in startups really an art or is it a science? And I'm going to be your host. And Mary's kindly introduced me and I've shared a little bit more on my backstory as well. I'm going to get into a little bit more as we go throughout the day. Okay. So the key question to begin with is like, why are you here? Like, what brought you here today? What inspired you to join this call today? Feel free to note in the chat. Let us know what really brought you here today. Okay. There's a number of reasons why you might be here today. All right. It might be because you're an angel investor already. You want to deepen your knowledge. You want to really understand a little bit more about what you've been doing already. You might have invested through an equity crowdfunding platform, or you may have invested directly into a startup yourself, right? Like someone says they want to learn more about angel investing. That's it. You've come to the right place today, right? I suspect the majority of people want to start learning about startups or investing into startups. That's why they're here, okay? There's some people sharing in the chat how much experience they've had today, and that's fine. This is designed as a foundational class, even for people who have never come across angel investing. So I'm going to try and speak in as simple term as possible, but I even have a habit sometimes of using language in the industry because I'm in it so much. So feel free to challenge me or drop a question in the chat if I'm using language that needs to be simplified or explained further. For other people, it might be work is boring and this is free. To be honest, I'm hoping most of you have finished work and haven't got that webinar on in the background from your work. All right, this is going to be much more engaging than that webinar anyway. Okay. All right, so Mark is sharing in the chat that he's done some investing, but he's keen to put some structure around it and to do it properly with friends. We're going to explore that later, Mark, especially what you said in terms of doing it properly with friends. And for a small few of you, you might actually be in the wrong webinar and this might be awkward, but that's okay. I still encourage you to stay and I still think you're going to get value from this. And if you get to the end and you haven't got value, you let me know and we'll sort you out and make sure that you get to the right webinar after. So the first thing that I want to go through is a bit of a presentation, which is an introduction, which gives a bit of a background into what angel investing is and the history of angel investing, which not many people are aware of. Okay, so we're going to go through this presentation. It is 15 slides, but I promise you I'll rattle through it quite quickly because I've done this quite a few times. Okay, so one thing that's very odd with my portfolio of investments, which is what you see on this slide, is that in UK and in Europe, very different to America, a lot of the angel investors and VC investors have historically, especially in the UK, come from a banking background. They've come from a finance background. So they're more used to taking calculated risk when making investments. So as a result, they look for more predictable business models, which tend to be B2B, okay, in Europe and in the UK, right? In America, it's very different because a lot of the CEOs and investors have come from sales backgrounds, like commercial backgrounds, head of sales. So they're a lot more comfortable with taking bigger risks. Some will call it being more ambitious. So as a result, they invest a lot more in consumer startups. And when I say consumer startups, what I'm talking about is startups that sell directly to customers or to individuals. So an example is in America, they've invested in the likes of Facebook, Snapchat, and the social networks that we know today. Whereas in Europe, there's not many of the social networks that you can name on your phone today that have come out of Europe. And there's a reason for that because of the behavior of the investors. The reason I share that backdrop is because 90% of my portfolio is actually B2C. And the reason for that is because I've uncovered a lot of Black people and people of color and women and non-binary, diverse people with potential who are solving problems for the very communities that they were raised in. And they're doing that in a way that's mostly B2C. So a lot of the startups here on the board represent that. They represent me pattern matching to the very community that I was raised with, okay? And that's why 90% of my portfolio is actually diverse. Whereas if you go to a typical VC's portfolio, that looks more like less than 5% of their portfolio is diverse. I didn't say less than 5% isn't Black founders. No, that's less than 0.5%, right? Less than 5% is in diverse founders, which includes women, which includes people of color, which includes people who are LGBTQIA, okay? So less than 5% of VC's portfolio are diverse. And there's no surprise that the partners that are invested in these VC firms match that. They're not very diverse. There's a narrow set of contributors. 86% of VC investors are white, Caucasian, middle-class men, all right? I'm going to share that as context, and we're going to get a little bit deeper into that now as I share the history story, okay? All right, so for hundreds of years, a secret market has existed where the wealthy and the powerful have gained privileged access to business deals that have literally changed the world. So at the dawn of the 20th century, we had JP Morgan, right? The actual man, Mr. JP Morgan, who invested in Thomas Edison, the man who actually was known for creating the light bulb, right? Using electricity in such a unique and novel, innovative way. That later led to the company that we know today as General Electric, that's still actually traded on the S&P 500, publicly listed. Then if we look at Cornelius Vanderbilt, he's invested in two brothers, the Wright brothers, who invented the airplane, which is actually my favorite invention, right? To think that you could bend metal around women and man and transport them from one place on the planet to another, still to me is incredible. And I feel actually every time I get on a plane, which has been rare over the last 2 years because of the pandemic, as you know. So this man here on this slide is a guy called Arthur Rock, and he was an investment banker in the East Coast in New York. And Mr. Arthur Rock traveled to Silicon Valley and invested $10,000, right, into a little known startup that would transform personal computing. That startup was Intel. And his initial investment in Intel was $10,000, made him a billionaire. Less than a decade later, another investor in Intel invests in another deal that will stand the test of time. That investor was Mike Markula, and he invested in Steve Jobs and Apple. Apple needs no introduction, but Apple was actually America's first trillion-dollar company. In 1980, Mike Markula's shares were worth $203 million. That was in 1980, right? And we all know what's happened since then to Apple's share price as the first trillion-dollar company. And actually on the slide here is Apple Park. And I don't know if any of you have visited there out in California, but it's incredible. So these investors invest at such an early stage, long before these companies IPO, which stands for initial public offering, which is the point at which these companies sell their private shares onto the public market, which means wider society and the public can now invest in those companies too, right? So companies like Coca-Cola or like Google today, we can buy stocks and shares into them because they're publicly listed on a stock exchange. So the stock exchange in this country, for example, is called the FTSE 100, right? But with startups, these are companies that are usually unlisted companies. They're privately owned, right? So that's where you need to have that privilege and that access to be able to invest into these companies. And we're going to touch on access a few times today because getting access into these deals is the really challenging things, and breaking into the network to get access to these deals is the real craft in getting into winning deals, okay? This slide here is an actual data from Uber's cap table, okay? And that stands for Uber's capitalization table. And put simply, what that means is this is the list of early investors in Uber. And you'll see a number of individuals here listed on the left. At the bottom, I've highlighted two individuals, Mike Walsh and Oren Michaels, because both of them invested $5,000. I'm going to pause on that a second. They invested $5,000, okay? Because they gained access through their network to Uber at such an early stage, they were allowed to come in and invest such a small amount to get involved in investing in startups. I know for some of you, this is profound because you never realized that you can invest as little as even £1,000, which I have 1,300 into my smallest deal, okay? So this is evidence of small ticket investing if you can gain access to those deals, okay? It's a really important point and we're gonna come back to it. Because traditionally, most of society have been locked out of these deals, but regulation and technological advancements have made it a lot more accessible. So for example, in America, there's platforms such as AngelList, which allow you to syndicate deals, which means invest alongside your friends to invest into startups. They actually spin up fund structures called special purpose vehicles. That means that the startup could receive, let's say, £50,000 in an investment, even though I've invested £1,000 alongside 50 friends who have put in £1,000 too, okay? So there's platforms that set up these compliance structures to enable you to do that, okay? But there's also equity crowdfunding platforms, and these differ as well, because what this allows you to do is to invest small amounts into brands that are basically raising from their crowd, raising from their fans, raising from their customers. So in America, there's a platform called Republic. In the UK, we have two called Seeders and Crowdcube, okay? And in the UK, we've also got fund structuring platforms similar to AngelList called Vaben and Odin, okay? The reason for the different fund structuring platforms in the different countries is because of the different jurisdictions, which means there's different regulation in each country, which makes it very complex and costly to be able to basically provide that service across multiple countries. So the question in many of your minds might be like, actually the next Alibaba or Uber or Google, are they really out there? And the answer is yeah, like technically they are. Like we're seeing startups like TikTok in the last 5 years go from nothing to something, right? So there are more innovations out there. The thing is whether we can really access them. You know, the privileged networks still continue to gain early access into these deals and invest, but access to great deals is hard to come by. It's even hard to come by for me, right? And we're not all privileged to necessarily access them. So then the exam question becomes, if I can't get into the best deals necessarily, or I can't invest much into these deals, why invest, right? What are the other benefits really of angel investing? You know, is it paying it forward and being helpful to the startup ecosystem? Is it in really applying your expertise because you've worked for 20 years in an industry like HR, you know it really well, and you can help a new founder on that journey of shaping their HR function, hiring people, shaping their culture, retaining top talent, creating personal development plans? Is there certain value adds that you can really package up as transferable skills from your day job to really apply to being a trusted advisor to a startup who needs those skills? Is it because you want to really democratize access to information, right? Is it because you want to learn about a new technology like NFTs or crypto or machine learning? Or maybe it's because you want to learn about a new type of industry or business model or new market or geography. It may be you want to learn about business building and this gives you the confidence and empowerment to do so. It could be because you work in the technology sector and actually you want to be able to share insights with peers and with clients that you're gaining from having skin in the game and investing into startups. The bottom line, and what I see from the hundreds of angel investors that I've spoken to over the years, is that this is a journey about continuous learning, right? It's about being valued for your skills, for your expertise, for who you are and what you bring to the table. But it's also about adding value. And a good friend of mine, Matt Pennycard, says it best: write the check, write off, and go to work. So my first exam question as we start this portion now where we open up to more conversation is, what is your angel investing motivation? What is motivating you to get started with angel investing? And I'd love to unmute and explore this and understand what it is that has got you interested in angel investing. And before you answer that question and unmute yourself and share your reasons, and I see there's a backlog in the chat that's really building up, which is great, and I'm going to get to it. There's a few questions that I've listed here at the bottom that we can explore, but I want you to be open-minded and asking your questions, where I have left some blank. And what we're going to do is we're going to explore these questions. We're going to figure out whether this is something you can influence and have control over or not. And we're going to decide whether it's an art or a science as we explore each topic, okay? And just for a frame of reference, when we teach at the Angel Investing School and we teach our cohort-based course across 8 weeks, this is the core curriculum that we usually teach around the overview of angel investing, sourcing and assessing deals. So how do I find great entrepreneurs to invest in? And how do I do my due diligence and research to ensure that I understand the risks that I'm taking by backing this founding team? Transaction economics is all about the math. It's all about understanding cap tables, dilution, what happens in future funding rounds, what's my return expectation, okay? The legal process and tax relief is what we teach in our UK courses, because in the UK, we have specific schemes that are government incentives that allow you to basically get some money back in tax relief of your income tax, called the SEIS, which is a Seed Enterprise Investment Scheme, and EIS, which is the Enterprise Investment Scheme. And put simply, a startup has to register for these schemes, which allows you as an investor to get up to 50% back in tax breaks, which means that if I invest £10,000 into startup A, I can actually get £5,000 back in a rebate, whilst that startup still receives their full £10,000 investment. It's quite a unique incentive that we have here in the UK. The fifth module is usually about adding value beyond capital, and it's my favorite. It's the one that I love to teach and have the opportunity to teach and facilitate classes, because it's really about you going to work as an extension of the team to really help that startup grow, to really help that startup share their vulnerability and their truth with you, to really help that startup make smart decisions on a consistent basis in growing the culture and the company that they want to shape for the future. And then we have developing your thesis, which is all about shaping what you choose to invest in and what you choose not to invest in, and how you track your investments with investment memos over time. Outside of that core curriculum, there's other bolt-on classes that we do, such as structuring deals. How do you use these fund structuring platforms? And then finally, we do a class on building your brand. Like, how do you build an attractive angel brand to really attract the right type of deal flow inbound, so you're attracting the right opportunities or entrepreneurs that you want to support and back? So I mentioned that, actually Mary mentioned kindly that I invest in gap closing companies. And what that means in a single sentence is I invest in companies that are closing gaps in society or for the planet. So like a climate change company, for example, like Alexis, which is one that I've invested in, or a company like a sustainable fashion company like Wearing, which I've invested in as an example. All right. So back to the first question, what motivates you to angel invest? And here I want to invite you to even just unmute yourself and just share your truth. Like, what is really motivating you to angel invest? Why do you want to invest into startups? So I want to open up the floor and invite you to interact with me and now share your perspective.
I can kick off if everyone else is quiet. So for me, I've got a few companies I'm invested in right now, and a lot of it is really this idea that if we, as a community, we talk about the numbers and how they're not that favorable, and there's a sort of big investing gap. And I think like we're just in this place where we just need to buy Black, buy women, we can't keep complaining. If we don't invest there, then no one else will. So I think for me, it's really just sort of owning that sort of corporate responsibility to whatever it is, whether it's £1,000 or the £5,000, the £10,000, whatever it is that I can, like put your money where your mouth is as it pertains to growing, Black business and stuff. And then just as you say, like, how do you add value beyond capital? So like in my day job, I'm a tech investor. So I do this for a Goldman Sachs. So why not do it for, small Black-owned, female-owned company, and support them by kind of advising and things like that. So I think it's just really about like more of what I can give. And then if I make a couple like sort of 10 times on it, then okay, cool. But it's sort of more from that perspective, I think.
I love that. And Mary, you touched on a really important point for us to drive home here, in that your focus is on being of service in what you can give and how you can be helpful. And that's where we all need to start. Even if we haven't got money to invest, we can be so helpful to founders, whether as a mentor, as an advisor, as a support, as an extension, as a customer. There's so much we can do to help. And sometimes we undervalue how much value we can add by just being helpful. The second thing that Mary touched on, which is really important to hit home, is it's very hard to invest in a unicorn. That's what gets reported about in TechCrunch and in the media, like these billion-dollar companies, these massive companies. It's very rare. That represents less than 1.001% of exits. A lot of the angel investors that I know that even have been lucky enough to make money have actually been on selling their shares in future rounds, or that company being acquired at a very early stage, right? So the majority of the angel investors are not actually doing it for a financial return. And this is going to blow some people's minds, because there's a lot of safer asset classes that you can invest in for safer returns. Property is an example, property investment, property development. Even public stocks and shares, and investing in an index tracker across the S&P 500 has more predictable and safer returns. Angel investing is very high risk. So a lot of people allocate less than 5% of their wealth to investing in this asset class as a result. It's actually the same rules that people apply when investing into crypto. It's so high risk, it's so volatile. I'll allocate less than 5% into the asset class, which is why I focused a lot on actually what is the added benefits, what is the added value that you get? Because at a minimum, if you don't get a return, are you willing to accept that you're learning? Are you willing to accept that you're giving back? Are you willing to accept you're learning about a new industry? These are the things that you need to talk to yourself about to understand if you're willing to take the risk and back a founder and really go all in not only investing your capital, but supporting them in building their business. Okay, so I want to hear from at least one or two others before I touch on a question that Marcus put into the chat. So anyone else want to share their motivation? All right, Sharon, you can go. Thank you.
That's all right. Thank you for your time, Andy. In terms of me wanting to get into this area, I guess it's like, different things, to be honest, probably a bit similar to Mary in terms of wanting to be of service to others within my community. And also I sort of work in my day job, I sort of work in a legal and business affairs capacity, but do so across intersection where it sort of meets media and entertainment meets technology. And I think for me in the past 12 months to about 18 months, I've been focusing more on in-car entertainment and how that area is developing, and just sort of seeing the potential there, and also the skill set around with other communities around me. So it's sort of deepening my understanding there as I do so in my day-to-day, but how can I transfer that skill set and sort of seek out more potential there and leverage what I can bring to the table as well. And it's important as ever to see women, Black women, people of color in this space. I think it's imperative. We bring so much to the table in our experiences in our day-to-day, and like you said, sometimes we undervalue ourselves when really we bring a whole lot to the table. So.
Absolutely. So Sharon, you've touched on a few things, but I'm going to touch on two in particular. The first is like when we talk about economic empowerment and leveling the playing field, and I say, if you can't see it, you can't believe it. I've had founders tell me how proud they are of the Black women they have on their cap table. And it's not even for the reason that they're just Black. It's because of the additional value that they add from their lived experience. And your lived experience isn't your role title at work. It's your whole lived experience. Mm-hmm. But we forget that sometimes when we're so used to these categories, like I'm a product manager and I'm a legal person. Yeah, you're also connected to these people. You're also interested in this thing. You're also curious about this thing. So we're all a function of our lived experience. We're not just one thing. We're not single issue beings. So you touch on that when you share some of the color that you just shared with your story and who you are and what you do beyond even just your job role. The second thing that was super interesting was that you shared that you've got deep insight into in-car technology and entertainment. So for me, I find that really interesting because if I was investing in that area, I don't have that knowledge. But I know that if I was part of an angel group with you, I can rely on you for the depth of insight that you have. And this is why it's a team sport.
Okay.
You know, that's why we have angel groups that we call angel syndicates, where people club together to say, actually, what are the different skills we have? You've got someone on legal, someone on HR, someone that has deep industry insights, such as in-car entertainment. So you've got a good team here to evaluate a deal and see the risks from different perspectives. And that is so powerful, because then actually as a team, you're leveraging not only your group economics in when you're investing into a deal together, but also the intelligence of the group, so that you can reduce the risks, and you can heighten the probability of you succeeding by adding value as a group, not just as an individual to the startup. So
I guess that's
I
the
think
due diligence part of things, right? Sort of,
absolutely. But even after, startups every month usually send these like investor update emails. And on these emails at the end, they usually have an ask. I've got an ask, I need some help with this thing. And that's when we go to our networks or to our groups to say, can any of us help with this thing? Right. And to have a group or a network to go to, it's network effects. It's going to amplify your ability to be helpful to that startup. You know, so there's real power there. So thank you for sharing that, Sharon.
no worries, thank you.
Excellent. All right, I'll ask for one more person to share their motivation, and then I'm going to ask for Mark to unmute, because I've seen 4 questions, but I want to ask which question you want to start with, Mark. By the way, Mark, I like it. Like, I like that you're asking the questions, so I encourage everyone else to ask questions like that as well. Who else wants to share their motivation for why they're getting started, why they would like to get started?
I can share.
Awesome, thank you.
Hi, so my name is Chichi. Thanks so much, Andy, for making the time. This has been great. So I know that you just said that it's very risky and you're unlikely to make money, but one of the reasons for me is actually like financial returns. I understand the riskiness. I know that it's unlikely to invest in the unicorn, but I think that's also something where like the learning part comes in. I want to learn what it means to be able to have a good idea of what would make a successful company that early on, because I'm sort of used to looking at later stage companies, mainly companies that are already public. So that's something that's really interesting to me. And I think it's just because I have this interest in companies and humans and human interest. So that's one thing for me. So it's the learning, and then hopefully the money. And then at the same time, it's, I guess, filling in the gap in the sense of, if the only reason that this company won't exist is because they need a couple £1,000s to make it for the next, you know, however many weeks or months or whatever to the next running round, and I can do that. That's extremely important for me. But I think it's the first 2 are the main ones. I don't know if
I love that. Yeah, no, no, but this is it. Be selfish. Sometimes we look at selfishness like as a guilty word or as a negative word. No, this is a personal journey. It's about yourself. So you should be selfish. And I love that you anchored on, I'm going to touch on 2 things again. This is becoming a pattern, right? Like, I love that you anchored on learning and your continuous learning. I could tell by the way you're talking that you're a continuous learner, and you're already applying and thinking through what's the differences between the later stage and bigger companies that you invested in, that you're familiar with, and these early stage companies. And one thing that I want to break down for the audience and for the audience to understand is, so I sometimes speak a bit fast when I'm passionate, so it happens, and I know it's happening now. So one thing that I want to understand, and I want you to understand, is that with later stage companies that are established, like a Microsoft or a Coca-Cola, okay, these companies are operating at a scale where they're focusing more on efficiencies and incremental growth, because they've figured out a predictable, scalable business model that works. With a founding team in a startup, they're at a very different stage. They're actually a team of researchers. And what they're doing is they're trying to research and figure out a scalable, repeatable business model that is going to work. Are they really solving a true customer problem? Is it a hair on fire problem? Is it a big and frequent problem that they're solving for? Are customers willing to keep using their product, keep paying for their product? This is what they're trying to figure out. And we get to a point as a startup, which we call product market fit, where we're getting so much demand that we're struggling to supply. And we feel like we need to raise some funds so we can grow the team quicker and accelerate the development of the product to keep up with the demand. Over the next 15 to 24 months, there's a very unique opportunity for everyone that's working in the corporate markets. You have a unique glimpse and viewpoint on the macroeconomics of what's going on in the market. You know that right now there's inflation, right? Inflation's gone up to what the real rate, I think, is about 10%. Like a third of the UK families before COVID are in poverty, okay? Our interest rate has gone from 0.5% to 2.5%. Yeah, these macroeconomic factors are going to impact the funding environment for startups. It's going to be a lot harder for startups to raise over these next months. So it's going to be interesting, the deals that you're going to be able to gain access to as angels, as startups start to cast the net wider and look wider for angel investors to tap into. And you've got a unique vantage point in that you can bring the best of corporate world to support them, not only in the insights on the macroeconomic market, but also how to operate with corporates. What you need to understand about the backdrop of a lot of founders is a lot of founders haven't actually worked in corporates. So there's certain things that you take for granted, like email etiquette, communication skills, whether on PowerPoint or Excel, your understanding of financials and numbers, like how to sell into a corporate, who's an influencer versus who's a buyer, procuring services. These are all valuable. And this is what I'm trying to say about going beyond your day job. You might just be aware of it because you're in the environment so much. You know what HR does, you know what sales does, you know what marketing does. Some of them don't know this stuff. So there's so much value you can add beyond the capital. And if there's like one or two take homes today, that's one of them that I really want you to understand and to take on board. All right, I think it's only fair now that I've left him in suspense. I'll ask for Mark to unmute himself so he can ask a couple of your questions. But I'll only answer a couple so I can give some other people space to answer their questions as well.
No, that's perfectly fair enough. And honestly, Andy, this has been really, really insightful. Thank you so much for your time this evening. So, I mean, just in terms of my questions, I mean, look, I mean, whatever one that you feel most sort of applicable to everyone and that would be more relevant for everyone would be helpful, really. I mean, I think for me, the second question would be helpful if you had some time to answer, and probably 1 and 2 really.
Okay, so on number 1, I actually posted a link on LinkedIn today, literally, about different sources of deal flow. It's a 10-minute video, and it walks through everything from cold emails to newsletters, communities, incubators, accelerators. It walks through all of the different sources of deal flow, okay? And the 2 tidbits that I want to share with you in summarizing that point before I share the link in the chat. I'm multitasking now, and as you can tell, I'm not as good at multitasking as many of you women, but I'm multitasking right now. So the 2 tidbits that I want to share is, the first is start from a place of just being helpful and being of service, just like what Mary said at the beginning. Whether that's being a mentor on an accelerator program like Techstars, or if I want to be on an accelerator program that focuses on Black founders, Black Valley, Color in Tech, like Foundervine, sign up as a mentor and start being helpful. You can start gaining access to the startups that are in those spaces, okay? The second one is, if you're interested, you can start developing a brand, start putting content out there, start publishing your investment thesis, publish your viewpoint and your perspective on a certain market, and it will attract conversation. It also attract deal flow from people that are interested in that same subject matter. Okay, that's something that I've done over the years that's helped me quite a lot in terms of inbound. And the third actually is really a combination, and it's about nurturing long-term strong relationships with founders and investors, because you get so many recommendations to credible startups to invest in from other founders and investors. It's both a blessing and a curse, okay? It's a curse because it feeds into that closed network that I'm talking about, right? Like, oh, Andy's a part of the club, so we're gonna share this with Andy. Okay, Andy gets in on a deal. But unless Andy's willing to share it with others and widen participation, then it's just a closed network that has access to that deal. The great thing is there's people like us on this call who want to democratize access. We get in on a deal, we want to bring others in with us. We're not treating this like it's just about us. No, it's about all of us being in service to this startup, okay? So I'm gonna share a link to that article now on LinkedIn, which has a video, which is 10 minutes, which you can walk through in your own time, and it'll share more details on what I've just discussed, okay? And it'll actually share actual sources of places as well. The second one, on what is your criteria that leads you to write a check? There's 4 broad areas that I focus on, okay? So get ready to take notes on these 4 areas. The first and most important, where I emphasize about 70 to 80% of my focuses, is on the founding team. I'm going to provide context to that in a second. The second is on the product. Okay, so what is the product? Like, I'll get into that in a second as well. The third is around the deal terms. What are the terms of this deal? Okay, and the fourth is about the market. Let me touch on all four very briefly. So when we talk about the founding team, the reason I emphasize that so much is because by the fact that we're investing in an early stage startup, we're taking a risk on a company that has no trading history. Yes, this company hasn't been running for 2 years. They haven't got accounts that they can give you. They haven't got, publicly listed accounts that you can access like a publicly listed company. They're a very new company. So they're risky by nature. Okay, this is part of why you're gaining privilege to invest at an early stage with the promise that if they do go far, actually those shares are going to be worth something because they're going to accumulate so much and they're going to grow so much in a short space of time. Like, these companies have no trading history. So they're very risky. They're highly risky. This is why a bank won't lend to these companies. Okay, so what you're really trying to figure out is, are these value aligned people, right? Is there chemistry here? Could we have a good relationship? Are they coachable? Maybe you personally have a rule around solo founders versus having a founding team of 2 or more. For some people, solo founders are not great because they haven't got someone to share the load with. They haven't got someone to share the risk with. They haven't got someone to share decision making with. So that individual and that individual connection is so important. Like, how has the team overcome adversity previously? I ask questions like that. Like, actually, like, can you tell me an example of when you and your founding partner overcame a challenge recently, and how did you come to a conclusion or decision? You know, I ask them questions about how they make trade-off decisions, because you're going to have to make a lot of those along the way. I ask questions about, if they succeed in 10 years, how does the world really change? And notice their answer. Like, have they really got an answer, or they're here for the sport of entrepreneurship because they want to be their own boss, but really they just needed a new job because they hated their old job? So those are the kind of things I'm really trying to tease out with the founding team. With the product, I'm really trying to figure out, is this a big and frequent problem that they're solving, or is it a nice to have? They call it a vitamin versus a painkiller. Is it a painkiller? Is it something that someone really needs, right? And I'll give you an example of this. With the Angel Investing School, the first course that we did, I sent a tweet out talking about the curriculum, and a PDF. It's embarrassing when I look back 2 years at how bad it was on Twitter. And then I sent an Airtable registration form. So I hacked together existing solutions to create this process to get people signed up to a school. And then I'd manage the community on Slack, and then I would use Zoom. I'm using about 10 pieces of existing software to stitch together this cohort experience. But 17 people were willing to pay for it. For 17 people, it was a big problem. For 17 people, they were willing to go through that unholy experience to gain this knowledge because they wanted it that bad. That's what you're looking for in these products. Okay. The third one is around deal terms. Deal terms is about just understanding actually what is this deal. So there's something called a convertible note. Okay, and many early stage founders use this, and there's different versions of this. In America, Y Combinator, a famous accelerator, popularized one called a SAFE, which, I can never remember what this acronym stands for. But a SAFE note is a version of a convertible note. In the UK, we've got something called an ASA and a Seed Fast, which is a version of a convertible note. And what this convertible note says, put simply, is I'm investing into this company, and my shares that I'm investing will convert to debt at a certain date if they have not closed their next funding round. But at the point that they close their next funding round, it converts to equity. Okay. In reality, no angel investor wants it to change into debt. So in reality, what happens is, if it gets close to that date, that founder usually negotiates to stretch that date by another 6 months, because you want that funding round to close, so that startup can have a valuation, and so that actually you can convert and have equity shares, because the equity will make you more than debt. Debt is not going to make you anything. The startup might fail and have no money, so you don't want any debt. All right, so that's our deal terms. That's the other thing that I focus on. Like, is there any terms that seem out of proportion, terms that I don't recognize, terms that are not standard? And you're not going to know that straight away, which is why it's important to work within a team. And even at the Angel Investor School, we created this Angel Investing School dictionary of 100+ key terms, because we understand actually how opaque and confusing these terms can be. I'll drop that into the chat after as well. So the fourth one was market. And market is interesting because Mark Andreessen famously said, like, you can have a great team and a bad market and the market always wins. You can have a bad team and a great market and the market always wins. But true magic happens when you have a great market that meets a great team, okay? And the reason for his focus so much on the market is because VCs and venture capitalists are in the business of investing into companies that are grow to be unicorns, grow to be billion-dollar companies, grow to be category-winning companies, right? Airbnb won that category, right? Uber have won that category. Like Microsoft have won that category. That's why we all know them. Yet there was a lot of competitors that failed where they have succeeded. The reason that for VCs, economically, they care about that is because VCs are raising other people's money. They're raising money from institutions such as family offices, such as endowment funds, all right? So they're raising money from other people. Therefore, they are reporting to these other people to say how they're performing based on the money that they've invested on their behalf. So in order to return their funds, when they raise a £500 million fund, they need big returns to be able to pay back those funds and make a return and to account for all of their losses in their portfolio. Angel investors is very different. We're not investing other people's money, we're investing on our own money. And that's why actually our return profile can be a lot lower than a VC's and we'll be okay. An example is a founder could exit for £30 million. It could be life-changing for the founder. It could be life-changing for the angel investor. It could be terrible for the VC that has a £500 million fund because it doesn't allow them to account for their losses and to pay for their portfolio. So the founder then has a tough decision to make because the VC is telling the founder, you're not ambitious enough, you can grow it more. And then the angel investor is saying, this is life-changing for you and for me. Like, do the right thing for you. You've had a long road here. You've done well. Like, I know you're tired of this journey. Maybe you have other aspirations. Both of them are equally right, but they're both coming at it from different perspectives. So the market is important to understand. But the market should not be a limiting factor. And the reason that I say that is because the most ambitious startups that become category winners always expand their initial market. Jeff Bezos of Amazon started with an online bookshelf. He then grew and had no right to start Kindle. And then AWS as an adjacent business is about online cloud servers, nothing to do with Amazon's original business. It now accounts for 50% of their operating profit, okay? Facebook, all right? Facebook started off as this social network. They grew through acquisition. They acquired Instagram, they acquired WhatsApp. It wasn't in their initial pitch deck, but they outgrew their initial market. Right? Airbnb started with trips so you can stay at people's houses. Now they're in experiences. Where they're going to go to next in the metaverse. So ambitious founders outgrow that initial market. So don't let that be a limiting factor to say why you're not investing in the company, which is why I say I focus mostly on that founding team. All right, so that's a very comprehensive answer, but I hope that helps to answer your question. I hope everyone actually gains shared understanding from me answering that question. Okay. I'm going to answer part of Mark's last question, question 4, on the 2 main mistakes that investors in our community make. I think the main mistake that a lot of first-time investors make is they allocate too much capital to their first deals. So really, they've got 20K, let's say, to invest into startups, period. And they invest that maybe 10K into 2 startups. No. There's a strategy called following your money. And what it means is you allocate small tickets initially and save 2/3 of your funds for follow-on capital onto your winners that are doing well and performing in the next 15 months. So for example, if I had 20K, I might invest £1,000 into 5 startups and build a portfolio of 5. And then in 15 months time, I learned that only 2 are still alive. This is really important to understand. And if it goes over your head, just ask me the question and I'll try and rephrase it. With the 2 that are remaining, I have 1% equity in each of them, just to make it simple, in simple terms to understand this. And what happens is when investors like VC investors invest in that funding round, I get diluted down. It's like pouring more water into Ribena, it gets lighter. So now my 1% has been reduced to 0.4%. And in order for me to maintain my 1%, I might have to invest maybe 5,000 into this round to maintain that 1% in my 2 winners. So now I've invested 10,000 into the 2 winners to maintain. And then that startup might continue to do well and go to Series C. But this time to participate and maintain my 1%, it might be 15K to avoid the dilution. So I might say, I'm not going to avoid it this time. In fact, I might get lucky. And a Series C VC might say, Andy, at this stage, I want to buy you off the cap table. So I'll buy your 1% investment and I'll buy it off you for 17K. And I'll say, okay, I'll sell it to you because I just made a 17x return on that £1,000. I know I just went through a lot right there, but it's really important to understand that lesson about following on your winners and dilution, because now we're talking about strategy. Okay, so the mistake a lot of people make initially is they follow passion instead of strategy. Yeah, I've made this mistake. The first investment I made over 8 years ago was into an African-based startup that worked on maintaining engineering equipment for mining companies in Africa. I knew nothing about the African continent. I was just in love with it because I'm Ghanaian. Yeah, facts. Secondly, I know nothing about engineering. Okay, and I didn't bounce off my network of engineers. I fell over head over heels because it was African. It was a Black founder. I want to support my own community. Little did I know, very quickly and I was overexposed. I invested way too much. It was around £5,000 at a time when I was earning maybe 25,000. It was crazy. But you got to be a little bit crazy when you're a founder. But anyway, we'll get onto that later. So that investment in 6 months quickly deteriorated into nothing because that startup suffered from working capital issues. They suffer from cash flow issues. When a small startup is selling sometimes to a big corporate, they suffer from payment terms. And if the payment terms are too far out and they haven't got enough money to service the products that they have, then suddenly they haven't got enough money to run the business. That's exactly what happened with this startup. I learned a harsh lesson. I call it my fast track MBA. But I'm telling you this story so that you avoid that mistake. You don't make the same mistake that I did. Okay. So I'm going to go down to, firstly, I'm going to open up. Does anyone have any other questions? Because Chichi, you asked some interesting questions. So I'm happy to go to you if you want to ask one of your questions.
Yes, please. Hold on, let me pull it up. So I think I'll ask the first one and then hopefully if there's time, I'll get to the second one. But you sort of spoke about how you can get people how you can get in the right crowd. Say you post a link and you spoke about how you can get deal flow to you. But let's say something like Seeders. So I think most people in England have access to it. But the problem is that I don't really know whether it's worth looking on there because they just sort of pitch anything. And I don't know if you spend a lot of time on there. And I think to sort of couple it up with Mary's question where she asked if you can ask those questions that you asked the founders to people on Seeders, because it doesn't really seem like you can do the research that you would actually want to do if you were investing on that platform as opposed to if investors came directly to you.
Yeah, you're right on all accounts. The relationship isn't the same on Seeders. I'm not actually a big fan personally of equity crowdfunding because a lot of the times the valuations are too high. So they're consumer startups. They've set the valuation at whatever they want, and it makes it hard for them to raise institutional rounds of VCs later, or they raise a down round, which is even worse. Okay, so Seeders is a hard platform. You don't have the same direct relationship with the founding team, and essentially sometimes it can be taken advantage of a crowd that's not educated. Right, it's very accessible. I can put £200 in it even if I don't understand, and actually even without education, I could be swindled a little bit. And a lot of people did that with Revolut, with Monzo. It's like, I know these brands, I love them, and now I can invest. Right now, one of my startups, actually Afrocentrics, are raising on Seeders. And the reason that they're raising on there is because as a consumer startup, they're really struggling with European VCs who favor B2B, like business to business. And in hindsight, and this was my initial advice when I had them on my accelerator program for Backstage in 2018, I told them that they need to break into the US as quick as possible. Because if they can break into retail in the US, such as Target, it becomes easier to raise from US VCs who understand that market. Plus, the Black population in the US is 10x what it is here in the UK. So this is where you have to be strategic, you know, as founders, and like really thinking through your funding roadmap and what you want to do. In this environment over the next 24 months, it's going to be really difficult though for founders, and a lot more are going to turn to equity crowdfunding because they've got restricted capital from the VCs because of the funding environment. It's just going to be a really tough environment. And a lot of them are now going to be focusing on efficiency. How can we slash our burn rate, reduce it as much as possible, and survive? Like, it's going to be less about growth unless they're companies that are well placed to take advantage of growth. So my most recent investment is a company called viSHEbility, and they provide different types of, does anyone know actually viSHEbility before I explain it? Okay, great. So I'm just spreading brand awareness for them, even better. So they provide different types of, oh, excellent. Mark knows it. Yeah, Mark, I'm not surprised, Mark. So they provide different types of creams for skin ailments and skin diseases like eczema, you know, like hyperpigmentation, and their creams are really effective, and they've been really growing direct to consumer in selling these creams, and 40% of their customer base is in the US. And in his first 2 years of running the company, this solo founder has generated 2 million in revenue. And this year, his goal was to generate about 5 million in revenue. Like between this crowd in this safe space, he's done that already. And I think he's going to probably generate closer to 10 million this year in revenue. So someone like him, he's in a more powerful position in terms of his optionality and in terms of who he chooses to raise from and what he chooses to do. But I hope that answers your question. I know I digressed a little bit at the end there with that story.
Yes, it does. Thank you.
Excellent, excellent. Jessica, I'm happy you've seen their adverts. It's probably customer stories of the effects of their cream on Instagram. Yes, and Nina says she knows who he is as well. Excellent, excellent. Is there any other questions? Sorry, so excellent. Go on, Chichi.
Sorry, can I go? Thank you. So this is my second question, which again, you kind of answered, but I wanted to ask it a bit more. So I was asking about how you present yourself as being qualified to sort of maybe give advice to startups, because like you said, it's not just financial capital you can give intellectual capital. And I know that you mentioned sort of maybe writing things on LinkedIn or giving, you know, writing newsletters or things like that to sort of talk about topics you're interested in, etc. But is there any way to do that doesn't require that? First of all, because one could be painfully shy, but also like, what if there's like circles you could be in where you sort of hear this information or where you would know that people looking for someone like that would come to this sort of circle?
Yeah, so this is a great question because I've built a personal brand very, very publicly, but I speak to so many people who want to create an influential brand, but don't care about followers and don't want to be in a public domain, for example, to protect their job, right? And the truth is, you need to become an influential person in the right circles, okay? And that really starts from becoming helpful. Like if a founder says to another founder, you need to work with Chichi, she's really helpful, you know, she's got deep expertise on law and she helped sort this problem out for me, that speaks volumes than reading what I said on LinkedIn. And I see it on the cap tables that I'm on, of these investors that I see time and time again. And what some of them, there's one investor in particular, you can't Google him. There's nothing on no social platform. But I see him on a few cap tables, and it's because founders are spreading the word for him because he's really helpful. So then the question becomes, how can you get into more trusted circles so that you can become a mentor, a trusted advisor, a help, a supporter to founders, and you can actually be really helpful so that they're recommending other deals to you, all right? So even just now, the one deal that I'm looking at called Farmland, who does lending to agricultural companies in developing countries, and is now developing a B2B platform to connect suppliers, because there's a supply chain risk globally, especially in this age of COVID, in that, you know, if I'm getting onions and garlic from Ukraine and I have no other options, what am I doing right now? So then they're solving that problem. And I only got access to that deal because another founder found me helpful and introduced me to that founder. That founder only took that meeting with me because that founder made that recommendation. So then the flywheel starts to happen, where your reputation starts to precede itself. And it helps when you have a focus, if I'm being honest. So whenever a fintech founder is raising, there's about 3 famous fintech investors that I always go to because they have a depth of expertise in fintech and they've invested in fintech for years. You know, so you get to build up a name, but you have to play your long game, not play the long game, not play my long game, play your long game around like what you want to be known for and what you're going to start being helpful for. And it takes time, but that's okay. Awesome. Awesome. Is there any other questions anyone has? I know this has been a bit of information overload, but I did advise at the beginning to take some notes because I was wary that actually, you know, some of this might go on top of your head. Some of this you might want to Google, some of this you might want to learn more, you know, so I hope you have been taking notes. Is there any other questions anyone else has?
I've got a question on your angel investor score. I've just been on the website to see that. I can see that you've got a cohort starting in September. Can you provide some more information about that at all, please? That'd be very helpful.
Yeah, absolutely. So there's a class going on right now actually on building a brand. And the Angel Investing School, the way it works is that we run an 8-week cohort-based course. So you join a cohort of around 30 individuals. And every week on a Wednesday from 6:30 to 8 o'clock, 1.5 hours, you go through a guided facilitation with an experienced angel investor or VC investor, which changes every week. So that person will take you through that guided topic. So today is about building a brand. It's actually the last session of this cohort. We're going to do a fireside in 2 weeks' time on an introduction to Web3 and investing in Web3 and NFTs to round off this cohort. But that's like a bonus course. But a course structure is the curriculum that I ran through with you. So like an overview of angel investing, which an angel investor will take. And then it's developing your investment thesis.
Yeah,
Then it's about
share that page. Do you want
Sorry?
to share again with that page?
Do you want me to show that page again?
Yeah, with that page, yeah.
Yeah, sure. I'll show that page. Although I really need to update that page, to be honest, but I'll show that page. So this is the on-demand course, actually. Hold on. I don't know if you can see my screen. Let me share my actual screen. Okay. All right. So this is the dictionary. I shared the link already in the chat. I'll just show the course page in a second. So when you go on the website, if you just even scroll down, you click on learn more, it will share more about the curriculum. So you've got an overview of angel investing, which is all about the history of angel investing, insights into the ecosystem. It touches on this story that I've touched on today, really, but goes deeper into that angel investor's personal journey and perspective of angel investing. Then, and this isn't in the order that it's taught in, by the way, but these are the 6 core curriculum topics. Then there's sourcing and assessing deals, which is about how you find great deals to invest in. And again, another angel investor takes that course usually. Then there's transaction economics, which is usually taught by a VC investor who walks through things such as conduct like valuations, the fundamentals of cap tables, dilutions, follow-on funding, return expectations. Then you've got the legal process and tax review, which is usually run by a lawyer and an accountant, or an angel syndicate who has both sides to their angel group and can facilitate that session. That's very UK specific, and I say that on purpose because we also do in-house training for corporates, where we do like 1-day training or training across 4 weeks as 2 hours per week. And a lot of that training is in the US, and in the US we don't run this same curriculum. Is slightly altered because in the US they don't have the same tax incentives. And then we have adding value beyond capital, which is about understanding the role of actually what can you do post-transaction? How can you continue to add value? How can you be helpful without being overbearing? How can you understand the boundary between being helpful versus actually taking too much time from a founder? And usually we go for a case study and an example there in that class. And then developing your thesis is one of the most important classes because that touches on really creating the boundaries to your playground. So creating filters and criteria for what you invest in and why. Okay, and then we've got an on-demand course, which is slightly different. So you don't have the cohort-based curriculum. Instead, this is a self-directed course that you can take at your own pace. It's more about introducing you into angel investing, so it doesn't go as deep. It's more inspirational, more motivational, and more touches at a high level on to take your first steps as an angel investor. So here the curriculum is a little different. We talk about first steps, introducing to angel investing, my journey, building an adaptive mindset, lessons on startups, deciding what to invest in. And at the bottom of this page, and I can share the link to this in the chat, you can see actually all of the lessons that sit underneath all of these headings, okay? So I have no bias, like I don't even require for any of you to sign up to the course, but if you want to sign up to the course, that is what the course entails, all right? Let me stop sharing so I can find you all again. That's what the course entails. Okay, so we do a mixture of corporate training in-house, and then we do public cohorts every April and September. So Mark was recently pointing to the fact that the signups now are for the September cohort. So we've got, I think, 3 places that have been paid for. So the majority of places are still available for that cohort. I've just shared the link for the on-demand course, and the normal website is just without the OD at the end. Is there any other questions before we round up?
I had a question around where, like, how do you know if you're thinking about your finances right now, how do you know that you might be ready?
From a financial perspective, okay, finance is very personal, but from a financial perspective, I would be thinking in my head, like, can I afford, what does 5% of my annual income look like? Or my annual savings is a better barometer. You know, is it £100? Is it £1,000? Is it £5,000? That gives you good window to say, okay, this is the money that I could play with. It's similar to saving up for a holiday. Like, you know, you might save up to 5,000 to go on a big holiday with your family. You can't go on holiday until you saved up that 5,000. Someone gave me eyebrows, maybe 2,000, I don't know. Okay. But it's a similar barometer. Like, how much is enough to have the holiday that I desire? You know, ask yourself, how much is enough that I can invest into 1 or 2 deals and save some money for follow-on investing? Okay. So some of the investors that have left the angel investing school are doing like £1,000 or £2,000 tickets into startups and saving up in case they need to follow up into those rounds, and slowly invested in just 1 or 2 startups a year to get started. But it's a personal journey, it's a personal choice. I'm currently on a program actually, and there are programs out there that take on angels and give angels money to invest. Okay, so because of the personal brand that I've built up, I'm on the Autonomous Co Angel program, where last year they gave me £100,000 to invest. This year they give me £200,000 to invest. They are rare. It is hard to get on those programs. I see someone give me the eyes like, wow, that's a lot of money. I know, but there are these programs that you can get on as well. So I just want to expose you to a full gamut of options. So in terms of your own personal financial position, think about yourself. What is 5% of my wealth? What is 5% that I'm allowed to risk? What is 5% that I can write off as a sunk cost or bad debt if it turns to nothing and I get nothing but learnings from this experience?
Amazing, thank you.
I have one more question. It's a follow-on from an answer you gave before. So you know when you said that when you're thinking about investing, you should save some money for follow-on, and you said, let's say you invest in 5 and then 2 are good, but there's every possibility that all 5 go to the toilet. So would you then just say, and this is probably obvious, but I just wanted to know how you think about it. If they all went bad, would you then just start from the beginning with what you have left over and then see if there are 2 from the next 5 that work well? Or would you sort of think, okay, I did 5, they went bad, then we go into 2 now, or is there like just to each their own?
So this is where you need to be a continuous learner. Okay, likely, like you're actually really investing every year, so it's never just 5. It might be like 2 more, then 2 more. But really, you need to be a continuous learner, which means that you need to assess all of the meetings you took with startups, the yeses and the nos. And the nos. Okay, this is your investment memo. This is your investment journal, and you need to look at that data and understand which of those startups went on to succeed, which one of those startups went on to get follow-on funding, which of those startups went on to scale, which of those startups went on to exit. And you need to study that data and think to yourself, what is the decision I could have made that was different? What have I learned from this experience so that when I carry on investing, I can incorporate the lessons that I've learned? So I shared my failure story at the beginning about investing out of passion and not being strategic. I don't make that mistake anymore because I've reflected on it, I've analyzed, I've learned the lessons, and I've incorporated it into how I invest today. We all have to have that continuous learning mentality. You know, I've got certain personal values. One of my personal values is Romans 12:2, actually, from the Bible, which says, do not conform to the pattern of this world, but be transformed by the renewing of your mind. And the renewing, that word is an active word. It means continuous, it means never ending, it means it's infinite. So I treat that same principle in how I think about when I'm investing, how I can be a continuous learner. Is there any, did that answer your question, by the way, Chichi? Excellent.
Yes, it did. It did. Thank you.
Excellent. All right. I'll take a final question. Is there any other questions before I round up? I'm happy that you love that. Thank you, Nina. Nina, do you have any questions before we round up?
No, but I am interested in the whole investing school type thing. I kind of, last year, my brother talked me into like investing in Bitcoin, and I was just kind of like, okay, fine. It has made money, even though it was, you know, it was only £100, but it's made money. But I'm just like, I need to start diversifying. But I like the idea of the whole getting into investing and learning along the way. So, and then like being able to add value, because me, I just think, oh, well, I just work in finance. Not even the juicy bit of finance, but it's like, well, maybe I could add value. And
Absolutely.
you know, and it's that whole, I think it's the whole combination of networking, investing, potentially making money, but then there's so many opportunities. So yeah, I'm kind of very interested, so I need to go and read more.
Well, look, Nina and Mary, I need to take Nima with me. I mean, she can sell this for me. I love that summary, and you summed it up beautifully. It is a mixture of that continuous learning, your own expertise, and your network. Okay, and if you've got that mindset where those things matter to you, then this is a really interesting journey to go on. You know, and you know, a lot of my learning now comes through like doing these deals. I'm learning about new technologies like NFT. I'm learning about cryptocurrency and blockchain. I'm learning about these things I wouldn't otherwise learn about, but because I'm participating in this industry and I'm practicing it, it's helping me actually learn a lot about it. So yeah, I think you summed that up beautifully. And I think my last message for everyone is that Asian investing school and angel investing shouldn't be all that you're looking at. Nina touched on an important word there around diversification, right? I started off in property and then I moved into stocks and shares, public stocks and shares, dabbled in things like bonds, and eventually got into investing into privately listed companies. Okay, I actually got equity positions in startups from working in them first. So I tell that story to say that think about your whole financial position and think about your whole portfolio. And I know Mary's got some exciting events probably lined up for you later in the year to touch on other asset classes in the portfolio. If not, she could give that talk herself, to be honest. But think about it holistically, because it's very easy to fall in love with startups and rockstar entrepreneurship, and it's sexy and it's interesting, but actually taking a step back and thinking about the whole picture, thinking about where you are economically. If you're saving up for a house right now, don't jeopardize that. The house is actually important. I encourage you to get the house. Like think about your whole financial position and make a sensible decision for yourself. But like I said, this is not financial advice, it's education, even though your financial advisor probably wouldn't tell you that.
Thanks, Andy. I have another question, but I think it's probably best if we take it offline, just because I don't think it's right with me plugging myself in this platform. So
you see, this is like a cliffhanger. You see, when someone sets it up in a way that they know they have to ask.
It's not even like that.
Come on, Mark.
No, it's just because I think it would probably take a lot more time than we.
Mark, ask the question and let us make the
decision. Ask the question. I want to know now. I'm curious. I want to know.
You want to know. The streets want to know.
It's not even that deep, but anyway, I'll just go for it. So basically, Andy, myself and my friends, there are about maybe up to 10 of us. We are sort of thinking to start our own sort of mini VC, and it's nothing crazy at all. It's just that we have a bit of money to play with, and we're thinking to like do a series of investments in the UK, Africa, and the US. Now the problem is we don't actually know exactly how to structure it, because there are quite a few of us partnering together, and I know like there are quite a few other sort of VC firms out there that do something relatively similar. I think there was one, I think Cornerstone comes to mind, that had a similar structure, but yeah, I mean, like, we're quite keen to get moving, but there are quite a few sort of roadblocks in terms of how to actually structure it. And of
all
course,
right. So let me just share two things really quick. So Mary, you work in, is it, Mary, let me not get this wrong. Is it Goldman Sachs or JP Morgan? Is it Goldman Sachs?
Oh, yeah.
All right, excellent. So Mary, Sean in launch of GS?
Yeah, Sean, yeah. She's a really good friend.
So Sean in launch of GS is holding an event for emerging fund managers.
That's a good point. She posted that.
So Mary can share the form with you so you can apply, Mark, because if you get into that room, you'll build a network of emerging fund managers. They can answer your question in that room, or that network that you gain access to can answer your question. If you fill out that form and you don't get on it, then you message me on LinkedIn, then I'll get your question answered.
Sounds better. Thank you. Really appreciate it. Thank you as well, Mary. Appreciate it.
Excellent.
Yeah, I can also connect you with a few people who are part of the Cornerstone Syndicate. So you can find out how they did it. I think in essence, yeah, there's probably the part of like, are we competing? But to be fair, the land is super green.
Yeah, I think they'll be open to sharing. Rodney and Edwin seem like they'll share.
Definitely, at least Andrew comes to mind. Mariola, who's a good friend of mine, comes to mind. So they were part of the really like early stage of Cornerstone Partners.
Yeah.
And so they can give you some insights into like how they started doing that.
Yeah.
So
exactly.
Don't mind sending me an email after this, I'll follow up with that as well.
And Mark, just the two things to bear in mind is think about the jurisdictions you're raising capital from, and think about the jurisdictions that you're investing capital into. Those are the two really important things to really sway how you structure a fund.
Very helpful. Thank you very much. Thank you both. Appreciate it.
And that's okay.
Excellent.
I'm actually just looking for Sean's post today.
To be honest, I've got the email. So if you email me, hello@andyayim.com. Oh yeah, there's the post exactly. And I think the form is linked into that post, isn't it? Yeah. Perfect.
Form as well. Exactly. So the form. Amazing.
Perfect.
Okay, we're like 5 minutes to the end, guys. Any last minute questions? Of course, Andy has been amazing. Virtual.
I don't have any questions. I just want to say thank you. It's been very enlightening. I'm very glad I left work early to come and join this. And yeah,
Excellent.
I'll be finding out more about the investing school.
Amazing.
Oh, excellent. Really pleased to hear that. Thank you. And Mary's to thank. She's the mastermind behind this, and she was very patient with me. So a big, round of applause for Mary. And let's encourage Mary to keep hosting more events. I know it's not easy to do outside of her demanding job, but it's adding value to the community. So thank you, Mary.
I appreciate that. And of course, virtual claps for Andy. Guys, that was amazing. There was lots of like insights, all the stories, all the little, that picture with like the early investors in Uber and the little ones at the end, that's mind-blowing. We got with Goldman, we worked on the sort of the Uber IPO. So knowing that you can basically start from there and the multiples that you can get, I think a lot of dots we're connecting there. So it's been amazing, guys. We're bang on time. I've been getting a lot of messages about the recording. It wasn't my plan to record the recording. It was not in the plan to share the recording, but I'll think about it.
Yeah, maybe we'll do unlisted YouTube or something and just share a private link of these that attended.
Yeah.
No, I'll send you my email and you can just email it to me pretty please. My computer died on me, so I missed part of it. So I kind of like need the recording to refresh.
I think what we'll do,
Mary's discretion.
We're taking the risk here because we're trying to record in 2 places and we're hoping that it actually works. I think that this recording actually works. If it does, I will send the recording to people on this group. But what I will just say is, obviously, you guys are here because you committed a couple of pounds to come here. So which Annie and I are probably going to give to charity or something, but we wanted to make sure, like, with these events and stuff, there's a lot of like people register, they don't show up, and we just